Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. The CEO of Ark Invest, Cathie Wood, is taking a big risk by betting against two companies that are facing financial problems. Value stocks are well known for being profitable when compared to market valuations. Two value stocks, according to Cathie, are about to become unprofitable. Cathie and other Ark employees have been privately experimenting with a method that could earn them a lot of profits. This method has been termed Ark on steroids because it effectively de-risks her portfolio while also increasing her returns. Two of the primary equities she's been shorting are experiencing serious problems behind the scenes. The two equities are Ford and General Motors. Over the last year, the valuations of Ford and General Motors, or GM, have risen. This is due to investors' trust in Ford and GM's future roles in electric vehicles. The Mustang Mach-E, Ford's first electric vehicle, went on sale in late 2020. This model is a fully electric SUV with a cost range and size similar to the Tesla Model Y. However, the vehicle's features aren't as bad as the Model Ys, which is why value investors have been buying Ford stock. Aside from the Mach-E, Ford is poised to begin mass production of the Ford F-150 Lightning, a car that many pickup truck lovers have been anticipating. GM has also been promoting its impending electric vehicle offering. By 2024, the majority of them will be in production. Even President Joe Biden jumped on the board, applauding GM CEO Mary Barra for spearheading the electric vehicle revolution. All of this sounds wonderful, but the truth is that the majority of these new items are producing serious financial problems. Electric vehicle sales are expected to increase in the future, and we're all aware of that. However, electric vehicles account for only about 3% of overall vehicle sales. Only 1% of GM's vehicle sales are electric, making this number considerably smaller. Ford is in a similar scenario, with electric vehicles accounting for only 1.44% of sales. The notion that Ford and GM stocks are soaring in support of this is absurd. The two automakers are increasing their EV sales, but they will lose 99% of their revenue. To make it worse, Ford and GM are unable to invest billions of dollars in EVs because their balance sheets are in a very bad situation. When capital lease commitments are excluded, Ford has $110 billion in long-term debt, while GM has $74 billion in long-term debt. GM recently increased its electric vehicle spending plan by 30% to $35 billion, a move that investors were bullish on. Ford soon followed, increasing its EV spending to $30 billion and bringing its stock to new highs. All of this expenditure is taking place while Ford's credit rating has been lowered to junk, and GM's credit rating is on the verge of being downgraded to trash. It will be impossible to fund such a significant EV spending plan while both automakers are trying to maintain their credit ratings. When these two automakers borrow money, the interest rate will have to be exceedingly high. Their low gross margin is one of the causes behind their poor credit ratings. GM has a 14.5% gross margin, while Ford has a 10% gross margin. Tesla, for example, has a gross margin of 23%, and investors frequently criticize Tesla for not being profitable. If the EV shift has a detrimental impact on Ford and GM's margins, the automakers may become unprofitable immediately. Because of their low P/E ratio, value investors choose to invest in legacy automakers. GM is trading at a forward P/E ratio of 8, while Ford is trading at a forward P/E ratio of 10. That may appear to be a low valuation, but consider what will happen if these two automakers become unprofitable. This might happen soon, especially because Ford and GM are about to lose 99% of their revenue. And there's more. Ford and GM are investing billions in electric vehicles, which will drastically reduce profit margins.
We saw that Ford's F-150 Lightning, that they were going to have to double production given all of the demand. Well, what they don't tell you during those appearances at CES and so forth is that electric vehicles make up maybe 2 to 3% of their sales, and that 97% of their revenue bases are gas-powered vehicles. And it's probably 90% plus of their production now. If there is the combination of the consumer turning off, not wanting to spend as much money, certainly not on big ticket items, and a preference shift, if they're going to spend on electric, then these OEMs have an issue. They have a problem. And we think we're going to hear more about it in the quarterly reports. And we hope analysts start asking about it. Now, I look at the performance of stocks like GM and Ford. They soared on those electric vehicle announcements. Think about that. That's ridiculous. It's only 2% of their sales. And what if the other 98% or so forth are on their way out as the consumer preference shifts toward electric? They have problems. They have problems because their gross margins, depending on the company, are somewhere between 10 and 20%. Those are very low gross margins. And if you look at the Bloomberg estimates for this year, 2022, after a very weak 2021, you see growth estimates in the 10, 15, 20% range. The US-based ones are at the higher end of that. Well, that may not happen. And again, they don't have a lot of room for error. And we have seen them pivoting and announcing that they're pivoting ever more quickly towards electric. But the problem is almost 100% of their base is going to go obsolete over time.
You may be wondering why Cathie Wood is shorting Ford and GM when she could go long on Tesla. Shorting a stock means that the maximum profit is 100% if the stock drops to zero, although the potential loss is unlimited. On the other hand, if you go long on a stock, the maximum loss is 100, while the greatest gain is potentially endless. Cathie Wood is making this decision in order to protect her investments against a market downturn. Everyone understands that general market values are at all-time highs, and that the market will eventually correct at some time. Cathie's Ford and GM short holdings would increase in value if the market crashed, while her long possessions would likely continue to decrease. Cathie's Ford and GM short holdings would increase in value if the markets crashed, while her long positions would likely continue to decrease. This indicates that her short and long positions are in opposition to one another. She's reducing short-term volatility while not sacrificing long-term returns by adding short positions to her portfolio. This maximizes the statistic called alpha, which is a volatility-adjusted return tracker. Cathie is simply hedging against overall market weakness by minimizing volatility. The high predictability of the results is another reason Cathie is shorting Ford and GM. Investors should not have bought auto stocks during the rise of autos in the early 1900s, according to Warren Buffett. Automobiles were replacing horses as a mode of transportation, but there was too much competition because the opportunity was so evident. Hundreds of automakers entered the industry, but only a handful of winners made it to the finish line. The sheer number of automakers made predicting extremely difficult on which ones would succeed. Conversely, it was obvious that horse-selling businesses would fail. Investors should have been shorting horse-related industries instead of buying auto stocks, according to Buffett. In this instance, Cathie is applying the same idea. Over time, it's almost certain that 99% of Ford and GM's revenue will vanish. Profits and sales will disappear as a result, and valuations will also plummet.
Electric makes up about 2, maybe 3% of these companies' revenues. They've got 97% that we think is on its way out. We don't know how long it will take, but there's going to be a lot of obsolescence there. And on top of that, there's going to be, I think, pretty much a bloodbath in the used car market. So, when it comes to valuation, I know that many analysts think that the auto manufacturers are valued around 10 times, maybe 10 times this year. We would submit that they may be looking at losses. And what's the valuation then? It's infinity. So yes, we know what we're talking about with that when it comes to valuation, and we also know what we're talking about when it comes to technology.
I've mentioned earlier about Ford and GM's financial difficulties. It's possible that the two automakers are dealing with much more serious issues than what I have just shared. Increasing manufacturing, especially for electric vehicles, is notoriously challenging because there were too many production issues while scaling up. For example, Elon Musk had to work 22 hours a day and sleep in the factory at one point. These problems problems are already troubling General Motors. GM's batteries have been exploding. Because of fire risks, the company had to recall 141,000 units of its flagship electric vehicle, the Chevrolet Bolt. This has caused a significant delay in GM's electric vehicle production. In the fourth quarter of 2021, GM only sold 26 electric vehicles, which Elon commented on by saying, "Room to improve." Ford is also having production troubles with its Mustang Mach-E, with the vehicle's windshields recently popping out. This is ironic given the leader of Ford's electric vehicle division, Darren Palmer, had criticized Tesla for making the same error. The doors fit properly, the plastics and other materials' colors match, the bumpers don't fall off, the roof doesn't come off when you wash it, the door handles don't get stuck in cold weather. Darren's comment on Ford's EVs. Darren is likely regretting his statement now that Ford is experiencing the issues he just mentioned. Ford and GM appear to be on the verge of experiencing the same production challenges that Tesla had. Massive losses, quality difficulties, and production ramp-up challenges are all on the table. All of this is in direct rivalry with Tesla, as well as Ford and GM's own gas-powered vehicles. The typical Ford and GM consumer would normally purchase higher-margin gas vehicles, but that demand is shifting to Ford and GM's new EV models, which have negative margins. What do you think? Maybe share your thoughts by leaving a comment down below. Again, thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.